Ray Dalio, no force on earth can stop what's coming for gold. I want to start with a number, 3. 3 separate forces hit gold in 2026. Each one was supposed to kill the bull market. Each one was declared by the financial press to be the end of the gold thesis. And I want to go through all 3 of them with you, because once you understand why none of them worked, once you understand why gold absorbed every single one of those blows and is still standing, you will understand something that almost nobody in financial media is saying clearly right now. There is no force operating in the current financial system that can stop what is coming for gold. Not the Federal Reserve, not a hawkish new Fed chair, not a war that sent oil to $112 and inflation expectations through the ceiling, not bond yields at 4.39%, not the strongest dollar reading in months, none of it. And I have spent 50 years studying every monetary system, every debt cycle, every geopolitical crisis that is intersected with gold markets. And I am telling you that the structural conditions in place right now make this the most powerful setup I have ever seen. Not the second most powerful, the most powerful ever. Let me show you exactly why. Force number 1, January 30th, 2026. Donald Trump nominates Kevin Warsh to replace Jerome Powell as chairman of the Federal Reserve. Warsh is a known hawk. He opposed quantitative easing in 2011 when every other Fed governor was for it. He wrote an op-ed in the Wall Street Journal in November 2025 titled "The Federal Reserve's Broken Leadership," arguing that inflation is a choice made by central banks and signaling his intention to shrink the Fed's balance sheet aggressively. The market's read was immediate and brutal. A hawkish Fed chair means higher rates for longer. Higher rates for longer means gold, which pays 0, loses its competitive position against Treasury bonds paying 4 or 5%. Gold fell nearly 15% in 48 hours. Silver fell 37% in a single session. The financial press declared the debasement trade dead, the gold bull market over, the thesis broken. Force number 2, February 28th, 2026, Operation Epic Fury. The United States and Israel launch coordinated strikes against Iran. The war everyone was told would send gold to $6,000 immediately begins. And then something happened that completely confused every investor who had bought gold as a geopolitical hedge. Gold spiked to $5,595 on January 29th before the war even started. And then as the bombs fell and the Strait of Hormuz closed and oil crossed $100 for the first time since 2022, gold fell. It fell from $5,595 all the way to $4,090 at its lowest point, down more than 26% from its peak during an active war, during the closure of the world's most critical oil choke point, during what the IEA called the greatest global energy security challenge in history. Gold fell. Force number 3, March 18th, 2026. The Federal Reserve holds rates at 3.5 to 3.75% for the second consecutive meeting and revises its dot plot from 2 rate cuts in 2026 down to 1. The hawkish hold lands on top of a February PPI reading of plus 0.7%, well above consensus. The 10-year Treasury yield jumps to 4.39%. The dollar index climbs toward 99.9, and gold, already under pressure from forces 1 and 2, falls again. 3 blows, each declared fatal by someone in financial media, and gold is still here, trading at $44.93 on March 29th, 2026. Still up dramatically from where it was 12 months ago. Still the subject of a $6,300 year-end target from J.P. Morgan, still being purchased by central banks at 3 times the historical average, still sitting on top of the most extreme structural case for a continued bull market I have seen in 50 years of watching these markets. Do you understand why that is? Not the surface explanation, the actual mechanism. Because if you don't, you are going to make the wrong decision at exactly the wrong moment. And that decision is going to cost you the most important trade of the next 5 years. I have been studying how gold moves during monetary and geopolitical crises for over 50 years. And what I'm going to show you today is not an opinion. It is a structural reality that has reasserted itself after every attempt to suppress gold in the last 50 years, without exception, every single time. And once you see it clearly, you cannot unsee it. And once you understand why nothing can stop it, the confusion you felt watching gold fall while the world burned will be replaced by something much more useful: conviction. Subscribe now and turn on the notification bell before we go further, because what I am about to explain is the framework that changes how you think about every gold headline you will ever see again. Let me start with Warsh, because I think the market's reaction to his nomination is the most instructive example of how the financial press confuses the short-term signal with the structural reality. The narrative was simple: Warsh is a hawk. Hawks raise rates or keep them high. High rates are bad for gold. Therefore, Warsh is bad for gold. Therefore, sell gold. That narrative is wrong, and I want to show you exactly why. The question is not whether Kevin Warsh wants to be hawkish. The question is whether the arithmetic of the United States federal debt allows him to be hawkish. And the answer to that question has nothing to do with what Warsh wants, what he believes, what he wrote in the Wall Street Journal, or what his track record at the Fed in 2008 looks like. The United States is currently paying $1.3 trillion annually in interest on $39 trillion in debt. That is the third largest line item in the federal budget, larger than defense spending, larger than Medicare, and it is growing every single month as the Treasury rolls over maturing debt at current rates and as the deficit adds new debt to the pile. The Congressional Budget Office projects the annual deficit will reach $1.9 trillion by the end of 2026. That means the debt is growing faster than the nominal GDP growth rate. The debt-to-GDP ratio is deteriorating on its current trajectory regardless of what the Fed does on rates. Now, here is the critical arithmetic. The Federal Reserve is currently holding rates at 3.5 to 3.75%. Every 100 basis points of additional rate increase adds approximately $390 billion in annual interest expense to the federal government's burden. To get from 3.75% to 20%, the level Paul Volcker used to break the 1970s inflation cycle, the federal government would need to find approximately $6.3 trillion in additional annual interest payments from somewhere. The entire federal tax revenue for 2025 was approximately $4.9 trillion. The arithmetic of replicating the Volcker response on a $39 trillion debt load is not difficult. It is impossible. It cannot be done. Kevin Warsh knows this. He is an intelligent man. He served on the Federal Reserve Board during the 2008 financial crisis. He understands the debt dynamics. And when the choice eventually comes between fighting inflation aggressively and preventing a fiscal crisis that would be far more destabilizing than the inflation, he will make the same choice any central banker in his position would make. He will cut rates. The debt demands it. The sell-off in gold on January 30th, when Warsh was nominated, was the market pricing in a set of policy actions that the arithmetic of the debt makes impossible. It was not wrong directionally. Warsh may well hold rates higher for longer than the market expected before the nomination, but the structural endpoint is determined by mathematics, not by the preferences of the Fed chair. And the mathematics says rates will eventually come down. The dollar will eventually weaken, and gold will respond to both simultaneously. Every investor who sold gold on January 30th because Warsh is a hawk made the same mistake. They priced the short-term signal correctly and the structural reality incorrectly. The structural reality is that the debt trap that the Federal Reserve is caught in does not change because a different person is sitting in the chair. Now let me walk you through the war, because the price action during the Iran war has been even more confusing to gold investors than the Warsh nomination. And for the same reason, the short-term signal is pointing in the opposite direction from the structural reality. The short-term signal is this: the Iran war drove Brent crude from $65 before the conflict began on February 28th to above $112 per barrel by mid-March. That oil spike drove inflation expectations higher immediately. The OECD revised its 2026 U.S. inflation forecast to 4.2% in late March. Elevated inflation expectations locked the Federal Reserve into a holding pattern on rates. A frozen Fed means elevated bond yields. The 10-year Treasury yield pushed to 4.39%. At 4.39%, the opportunity cost of holding gold, which pays nothing, is significant. Institutional capital rotates into Treasury bonds. Simultaneously, global investors seeking safety buy dollar-denominated assets. The dollar strengthens, and a stronger dollar mechanically suppresses the dollar price of gold because gold is priced in dollars. Three headwinds simultaneously, all three created by the same war that was supposed to be bullish for gold. Write down these 6 steps: oil shock, inflation expectations rise, Fed frozen, bond yields elevated, opportunity cost against gold rises, dollar strengthens, gold falls. This is the mechanism. This is why gold fell 26% from its January peak while bombs were falling in the Middle East. And this is why it has always fallen during the initial phase of every major geopolitical oil shock in the last 50 years. The mechanism is not new. The mechanism is not unique to 2026. It is a mechanical sequence that has repeated after every major oil shock since 1973 without exception. But here is the part that the financial press is not telling you. This mechanism does not last. It has never lasted. And the historical record of what happens after it exhausts itself is the most important data set for every gold investor alive right now. 1973, OPEC embargo. Oil quadruples from $3 to $12. Gold falls initially. Then over the following 2 years, gold rises 150%. Zoom out to the full 1971 to 1980 arc, and gold rose 2,300%. Not a typo. 1979, Iranian Revolution. Oil collapses in supply. Gold does nothing immediately, then rises 89% over the following 12 months. 1990, Gulf War. Gold pops 10%, then gives it back entirely. Then the structural move comes. 2001, September 11th. Gold at $250 per ounce. Looks broken. Begins a 660% decade-long bull run. 2022, Russia invades Ukraine. Gold breaks $2,000 for the first time in history, every major oil shock in 50 years, followed by gold outperformance once the mechanical suppression exhausted itself. Not luck, not coincidence. Because the mechanism that suppresses gold temporarily, higher yields, stronger dollar, opportunity cost rotation, always eventually reverses. And when it reverses, the structural case reasserts itself with full force. Now, here is what is different about 2026. Because every previous cycle had the suppression mechanism operating, but none of them had the suppression mechanism operating against a structural backdrop this extreme. In 1973, national debt was $500 billion. Today it is $39 trillion. That is not a larger version of the same thing. That is a categorically different fiscal reality with categorically different constraints on the Fed's ability to sustain a hawkish policy stance. Paul Volcker could raise rates to 20% because the debt service on $500 billion at 20% was manageable, painful, but manageable. Kevin Warsh cannot raise rates to 20% because the debt service on $39 trillion at 20% would exceed the entire federal tax revenue of the United States. The constraint is not political, it is mathematical. In 1973, central banks were selling gold. Today, central banks are buying approximately 755 tons of gold in 2026 alone, 3 consecutive years of purchases above historical averages. This is not portfolio diversification. It is strategic repositioning at a scale the gold market has never seen. Central banks buy on decade-long time horizons. When central banks are accumulating gold at this scale during a period of mechanical price suppression, they are telling you something about what they believe the structural trajectory looks like over the next decade. They are not confused by the war headlines. They are not scared by the Warsh nomination. They are doing arithmetic on a longer time horizon than retail investors, and their arithmetic says buy. In 1973, there was no silver supply deficit. The silver market in 2026 is navigating its 5th consecutive year of industrial consumption outpacing mine supply. 5 consecutive years. And the mine supply cannot respond to higher prices quickly because silver is produced as a byproduct of copper, lead, and zinc mining. You cannot decide to produce more silver in response to a price signal. The production timeline from discovery to output is a decade or more. 5 years of cumulative deficit, no supply response coming. In 1973, industrial silver demand was a fraction of what it is today. Today, silver is in every solar panel, every electric vehicle, every AI data center, every defense electronic system. Electric vehicles require 60 to 80 grams of silver per vehicle. Conventional cars require 15 to 20 grams. As EV adoption scales globally, the structural demand growth is not optional. It is baked into every major economy's energy transition plan, and the demand is inelastic at current price levels because silver represents a fraction of the total system cost in each application. You are not going to redesign a solar panel to avoid using silver because the silver in that panel costs slightly more. And in 1973, Paul Volcker had the option to resolve the inflation with rates. Today, the Fed cannot use that tool at the scale required, which means the inflation that the Iran war oil shock is embedding into the system is not going to be defeated. It is going to be absorbed, and absorbed inflation over time is the single most powerful structural driver of gold prices in the history of precious metals markets. Every structural condition is more extreme than 1973. Every structural driver is more powerful, and the mechanical suppression that is currently holding gold at 4,493s, while J.P. Morgan forecasts $6,300 by year-end, is temporary. Now let me walk you through the 4 phases, because understanding which phase we are currently in tells you exactly what to do with the information I am giving you. Phase 1, the panic phase. This is weeks 1 through 4 of the crisis. Oil spikes. Gold spikes initially, then drops hard as the mechanical sequence takes hold. Financial media runs 24-hour coverage designed to maximize anxiety. Most retail investors do one of 2 things. They panic sell at the bottom of the initial drop, or they panic buy gold at the absolute top of the initial spike. The initial spike to $5,595 on January 29th was the retail panic buy. The drop from $5,595 to $4,090 at the lowest point was the mechanical suppression combined with the panic selling that followed. What were institutions doing during phase 1? Watching. They have seen this before. They are not doing anything dramatic. They are calculating. Phase 2, the absorption phase, month 2 through 3. The initial panic subsides. The VIX comes down. Gold pulls back further from its spike. Silver falls harder, 15 to 20% or more. This is where the largest number of individual investors make their most expensive mistake. They look at their portfolio, they see red, they read a headline saying gold has failed as a safe haven, and they sell. In 50 years of watching markets, I have seen this happen after every single major crisis. And in every case, it was the worst possible time to sell. Not because I am always right about what comes next, but because phase 2 is almost always the bottom. And selling at the bottom is how investors lock in permanent losses instead of participating in recoveries. Based on the timeline of the Iran war beginning February 28th and the price action I have been observing through late March 2026, I believe we are somewhere in the transition between phase 2 and phase 3. The panic selling has occurred. The forced institutional liquidation from margin calls has largely exhausted itself. Gold recovering to $4,460 on March 27th on news of Trump pausing Iran strikes after hitting a low near $4,090 weeks earlier is consistent with the absorption phase completing and the structural bid beginning to form. Phase 3, the structural bid phase, month 4 through 18, the panic-driven selling exhausts itself. The structural buyers begin to dominate price action. Central banks, who have been buying throughout the suppression period, continue to accumulate. Long-term institutional allocators rebalance into real assets. Physical gold buyers in Asia continue purchasing. Gold finds a genuine structural bid, not the fear bid from phase 1. The structural bid backed by debt dynamics, central bank accumulation, silver supply deficits, and the eventual monetary policy reversal that the debt arithmetic makes inevitable. Ed Yardeni, after lowering his near-term 2026 forecast to $5,000, is holding his decade-end target at $10,000 per ounce. That is not a bubble forecast. That is a debt cycle forecast, and most retail investors are sitting on the sidelines during phase 3, having sold in phase 2, too scared to re-enter, watching gold make new highs and telling themselves they will buy on the next pullback. The pullback may never come at a price they recognize as attractive. Phase 4, new all-time highs, month 12 onwards. This is what the historical record shows after every major oil shock without exception. 1979 to 1980, new all-time highs. Post-September 2001, new all-time highs sustained for a decade. Post-2022, new all-time highs. The mechanism is the same every time. The oil shock embeds inflation. The inflation forces the Fed to keep rates elevated for longer than the economy can sustain. Eventually, the debt arithmetic overwhelms the inflation-fighting mandate. Rates come down, the dollar weakens. All three headwinds reverse simultaneously, and gold responds to all three tailwinds at once faster and further than most models predicted. Now let me close with the two indicators I am personally watching because these are the only two numbers that matter. Everything else is noise. The first is the US dollar index, currently elevated above 99 on petrodollar safe haven demand from the oil shock. When the DXY falls back below approximately 97, the primary mechanical headwind on gold begins to diminish. This will happen when oil prices stabilize as alternative supply routes through Saudi and Emirati bypass infrastructure absorb enough of the Hormuz disruption, or when a diplomatic framework creates expectations of de-escalation. Watch the dollar index, not the war headlines. The second is the 10-year Treasury yield, currently at 4.39%. When this falls back below 3.5%, the opportunity cost argument against gold collapses and institutional rotation back into gold begins at scale. This will happen when the Federal Reserve begins cutting rates, which will happen when the debt arithmetic of 39 trillion at 4 to 5% makes continued hawkishness more dangerous than the inflation it is trying to prevent. Kevin Warsh will cut rates when the math forces him to, not because he wants to, because the alternative is a fiscal crisis more severe than the inflation problem. Watch the yield, not the Warsh biography. These two numbers contain everything you need to know about when the structural suppression is ending. The war news will not tell you. The ceasefire rumors will not tell you. The financial media's 24-hour cycle will not tell you. Two numbers, dollar below 97, yield below 3.5. Everything else is noise. Wells Fargo lifted its 2026 gold target to $6,100 to $6,300 in March 2026. JP Morgan forecasts $6,300 by year end. UBS targets $6,200 by September 2026. These are not the wishes of retail investors who need the price to go up to feel validated. These are the research departments of institutions that collectively manage more capital than any entity on earth. They are not issuing these targets because they believe the mechanical suppression is permanent. They are issuing them because they have done the structural analysis and concluded that the suppression is temporary, and they have calculated what happens when it reverses. There are two types of investors looking at gold at 493 or right now. The first type sees gold down from $5,595 with a hawkish new Fed chair arriving in May, with the Iran war still unresolved, with inflation expectations elevated, with yields at 4.39%, and concludes the trade is over. The thesis was wrong. Gold failed. They sell. And 12 months from now, when gold is at new all-time highs, they will say they knew they should have held, but they will not hold. Because when gold is at new highs, they will tell themselves it has gone too far and wait for the pullback. The pullback will come in the form of another phase 1 or phase 2, another moment of maximum confusion, and they will sell again. The second type looks at the same $493 and thinks something completely different. They think phase 2 absorption, mechanical suppression, the same sequence that is played out after every major oil shock in 50 years. They think central banks are buying at these levels. They think Warsh cannot be as hawkish as the market believes because the arithmetic of 39 trillion does not allow it. They think the gap between $4,093 and $6,300 is not random noise. It is the calculated distance between where the mechanical suppression holds the price today and where the structural conditions say it is going when the suppression eventually reverses. And they accumulate quietly, patiently, without drama, while the noise is at its loudest. I have watched both types of investors across every major crisis of the last 50 years. I know which type builds wealth, and I know which type watches it happen from the sidelines. Three forces hit gold in 2026: a hawkish Fed chair nomination, a war that closed the world's most important oil choke point, a frozen Federal Reserve holding rates into an oil-driven inflation surge. Each one was supposed to be the kill shot. None of them changed the structural conditions. The debt is still $39 trillion, then the central banks are still buying 755 tons annually. The silver deficit is still in its 5th consecutive year. The Fed is still trapped between inflation and a debt load that makes aggressive monetary tightening impossible. Nothing stopped gold structurally. Everything that hit it was mechanical and temporary. Watch the dollar, watch the yield. Be patient. And do not let a phase 2 sell-off, regardless of what caused it, make you miss the move that every major institution on earth has already calculated is coming.